microphones.
All right, we got a lot to talk about even for my fast talking, so let's go ahead and get on it. First of all, for the idea assignment that's due on Friday, again, the idea assignments are optional, so you may want to opt out, especially after the other news I share with you here shortly. But if you started working the idea assignments or if you plan on starting work on them, please let me know if you encountered any issues. We've already had one student that's encountered an issue with technology. IDEA has a rich history with the Truman State Network of creating pandemonium, and I'm a little bit worried that they're playing with the remote desktop and the virtual image, moving the IDEA program to a separate remote desktop folder may create issues. If you're able to complete it, fine. Don't worry about it. I've seen the one person has already completed the IDEA assignment, but I would like to get some updates on it just to see if everybody's having issues.
Can I like access idea on my own?
Yes, you can do it through the remote desktop view.truman.edu. There's also instructions if you want to download the IDEA program. It's in the syllabus. It's a little bit longer and more arduous, and you have to put a program on your computer, but you can do that as well. All right. Yep. All right. So there's a couple of things that I've added to the week one folder that I want to bring up. One was one I wanted to do on Monday, but we ran out of time. So the first one's a MAC interest survey, and this is just for the master's accountancy. So for those of you who don't know, on August 28th, the rules for the CPA exam licensure will be changing from 150 hours to 120 hours for the state of Missouri. That's true for a lot of states now. It's actually a pretty big national trend. I'd say, I think 45 or 46 of the states will be in that position by the end of the year. So we're trying to gauge what the plan is for the accounting students who are moving forward, if they're going to be taking the CPA exam, and probably more importantly for us, if you're planning on doing the MAC program, whether next year or the year after. So please complete that survey. You may get asked to do that in some of your other senior courses. In fact, if you're in Dr. Caden's course or you're in Dr. Eisen's course right now, they may have done it. Dr. Caden, maybe. Dr. Eisen, definitely not. Did I just trash talk one of my fellow faculty members? Yes. All right. Yeah, I have to remind them to do like things like 3 times. So, but yeah, please fill out that survey. It's pretty short and to the point. It's only 4 questions. And if you don't know, that's fine. But we're just trying to make some plans for the future and try to get a gauge of that. So we're trying to touch base with all of our seniors to get that. The next one is going to be relevant. I mentioned that there was an alternate assignment to the IDEA assignment, and I've set up the preliminary items for that. So there's some instructions. It's pretty straightforward. In fact, again, one student has already actually submitted the first few assignments for this, which is pretty funny considering we haven't even talked about auditing yet. As far as this goes, it's basically a website called Tax Assembly, which there's some sort of hidden joke there about me teaching tax in my auditing class, but that was actually the name of the site. I got asked by the creator of the site and a former student who's working with them to do some beta testing, so we're going to be beta testing. Basically, all you need to do is go to this website and type in the class code. It's 2567 and register for this particular course. And I've already set up some assignments. The assignment due dates are basically listed here. I do want to clarify this. They are fairly straightforward, and I think they're actually really good the way they're set up. I don't like that they're all multiple choice, but I'll take what I can get. As far as the content goes, they're really, really kind of innovative in the way they approach this. It is going to be fewer points in the IDEA assignment currently, simply because it is a much easier set of assignments, but can be substituted for the IDEA assignments for the purposes of opting out of the final exam. If you want to complete both the IDEA assignments and these assignments, you're welcome to do so. You can get extra points for doing that. So it'll still be whatever those assignments are worth. Currently, there are going to be 35 assignments that I'm going to assign, and they will be worth 1 point apiece. These are completion based, so you do not need to get every single answer right. You just need to complete the assignment. I'll get in just a second. But I do want to make note that I do expect you to put effort in answering the questions. If I see constant response rates of like 20% accuracy from a person, I'll say, well, that person is just plugging in answers and just going to multiple choice. So we will be monitoring that, but it's not based on your accuracy. Okay, as long as you just put in a legitimate effort. What was that?
You said we'll get extra points if we do both of them.
Does that count as the extra credit towards not having to take the final?
So it's not technically extra credit, but it'll be extra points. So like your final grade, instead of being like out of 500 points, if you do the tax assembly assignments and idea, you get 535 points. Yeah. So it's still extra points, but it's basically they're kind of guaranteed points as long as you do everything correctly. So you're just adding extra points on both the numerator and denominator, which helps out the numerator substantially. Good question though. Yeah, so this should be pretty easy, straightforward. I've not got all of the assignments set up yet. I've only got through week 3, but I will be doing that periodically throughout the semester. I may add some assignments. This is going to be something that they told me they're going to update throughout the semester, so I'll let you know if there's going to be additional points added. For right now, it's just going to be tentatively worth 35 points, and again, you can use this as your substitute for idea to opt out of the final exam. Yeah. I think that manages everything, but again, if you run into any problems, please shoot me an email. Again, we're kind of working through our unknown territory here, both with IDEA and tax assembly right now. So it's kind of exciting, but it's also a little bit intimidating. All right. This is my favorite lecture of the entire semester, getting to introduce everybody to auditing. I'm going to have to go through this faster than usual because I just wasted, how much time have I got? I just wasted 5 minutes on the announcements. So usually this takes the entire class period and I still don't cover it as well as I'd like. So I want to start out talking about the introduction to auditing with a couple of semi-rhetorical questions, all right? So what's your goal in this course? Somebody's going to answer, says, I want to learn auditing, Dr. Barnes. I want to be the best auditor possible. It's like Pokemon. I want to be the very best. Yeah. It's like surprised that I know that. Yeah. I babysat a kid back in the 90s. All right. Anyway. So no, let's be honest. What is your grade? Or what's your grade? What's your goal? You can see where my mind was on that. So you want to get a good grade, right? Yeah. Okay. So yeah, get a good grade. Yeah. So what's my goal? Is that the same thing? It's like, yeah, well, I hope so, Dr. Barnes. Hope you want to give us all A's. You know, if you all earn all A's, I will give you all A's. I promise you that. But is my goal the same as yours? I want you all to learn auditing. Okay. So that's important to note. We have different goals. What about after graduation? What is your goal? After you graduate with either your bachelor's or master's, whatever you're going to get as your final degree, what's your goal? Is it really to get a job? Oh, well, I mean, is that the end result? Like if I say I will hire you right now and give you a job working in whatever you want, but I'm not going to give you any money for it.
Yes, I want mine.
Yeah.
That makes a lot of money.
You know,
CPA.
Yeah, I want to make the money. And so the CPA is kind of also that sign that means to an end that if you pass the CPA exam, you generally are a lot more marketable and can leverage that degree more favorably. So can we agree that kind of the end result is to make money? Is anybody here, would they turn down $1 million a year offer with no work at all? If I say, I'm just going to give you $1 million a year to scroll on TikTok all day. That would probably get boring after a while, but yeah, I think everybody would be happy with $1 million a year with no requirements, no job requirements. What's your employer want? What is their goal? Results. Yeah, they want somebody who can do the job that they're trying to hire for. Okay. So again, we don't necessarily have an alignment in goals. All right. Now let's hold that in thought because we need to actually keep that in mind. So everybody heard principal agent theory? This is a kind of finance concept. So basically, there's two parties in an organization in traditional capital market frameworks. There's the principals and agents. Who are the principals? Anybody remember that? So the principals are the owners. They're absentee owners of an organization. Absentee owners of an organization. Again, this is traditional capital markets where we have equity interest in an organization, publicly owned. So who are the agents? The shareholders are the owners. So the agents would be who represent the shareholders. Who's that in most organizations? Well, you know, the board are still the owners, technically speaking, but
Questions for like
management, that's where we're going. Yeah, management. Okay. So they're the people who run the organization on a day-to-day basis. All right. So different parties, there can actually be some overlap there. You can have people who have ownership that are also management, but technically speaking, they're two different groups. All right. Now, which group of those individuals did you assume has more knowledge about the way the organization operates on a day-to-day basis? Is that going to be the absentee owners or the management? Management. Okay. So there's a problem in that management has more information about what's going on, so they can leverage that information to their own benefit. Do we have a solution for that in financial accounting? What'd you all learn how to do back in 221 and 302 and 303? Create these documents. What are those called? Financial statements. Yes, financial statements are created to actually provide some transparency about the way the whole organization operates. So that was kind of the idea. So this alleviates something called information asymmetry, where one party has more knowledge than the other. In our situation, management has more knowledge about the operations of the organization than the principals do. Okay. Now we also have an issue with the conflict of interest. If you're a manager, what are you concerned about? Are you concerned about the organization doing really, really well?
You want to maximize shareholders.
Kind of. You want to maximize value, but do you want to maximize shareholder value? Or do you want to maximize your own personal value? Yeah, your own value. You want to maximize your own value. Now, if you're an owner of an organization, you're more concerned about wealth. You want concerned about the long-term benefits of the organization and how it's going to stay in place. Whereas if you're a manager, you're more concerned about what your current situation is. Because if you don't meet your current goals, it doesn't matter whether the long-term wealth of the organization is in place, you're not going to be there. So managers tend to be short-term, owners tend to be long-term focused. So that creates a conflict of interest because managers may make decisions that benefits themselves, but not necessarily the organization. There's a primary example of this one you probably heard of. Has anybody heard of Enron? We'll talk about that one a lot, okay? Enron, that was kind of a prime example of where managers did things that were basically harmful to the organization in the long term, but helped them in the short term. So we've got this conflict of interest. We got this information asymmetry. How do we fix this problem? Well, one mechanism we talked about was going to be those financial statements, those financial reports that were going to be generated. But we know that there could be an issue because management could lie in the financial statement. So they could be inaccurate. They could give us information that's not correct. So we need a mechanism to come in place to say, this information is correct. It is effectively accurate. And that is what we call the role of the auditor. So that role of the auditor is to act as a mediator between the management and the owners to actually provide a little bit more transparency as to the operations of the organization. All right, so we're going to take a little bit of a look at that, but I want to ask you a few more rhetorical questions, okay? So I want you all to know auditing, right? And you're going to assert to me, I know auditing. You're going to say no auditing, okay? So how can I actually evaluate your knowledge of auditing in this course? What's going to be my primary mechanism for doing so?
Yeah.
Exams, yes, exams, okay? There we go. There's the front page of exams, the one that I always use, okay? What about what's a mechanism that your potential future employer is going to use to evaluate whether or not you're going to be qualified to do a job? Resume, yeah, those resumes, yeah. So auditors actually have the similar mechanism that they basically make an attestation of whether or not a company is operating correctly, and that's going to be a report. Now, don't worry about what's on this report. This is an old format of the report. They've changed the report like a dozen times since I created the slide many, many years ago. But yeah, I've updated the slides, but some of the slides still have basic information. So this picture is outdated, but it's a report, front page of a report. The way this operates is that we've got information asymmetry and conflicts of interest between the principal and the principals and the managers, the principals and agents, the owners and the managers. Independent auditors step in. They're a party of the owner, but they basically work with management to make sure that all the information that's being conveyed by management to the owner is accurate, is correct in effect. So they're going to look at the financial reporting information and they're going to say, this is correct or this is incorrect, whatever the case may be. Now, we'll talk about the nuances of that here in just a second, but I want to go a little bit deeper into this idea of the examinations and the resume. So in the examination example, what assertions are you making regarding this course? Well, we already talked about that. You're asserting that you know auditing, okay? I've put the content forth to you. You've done homework, you've done preparation work. And so when you are making the assertion at the end of the semester, you're saying, all right, I know auditing, and I'm going to test that by giving you exams, all right? In the resume example, the assertions you're making regarding your qualification for the job, that you are qualified and that you are worth the amount of money that they're paying you. The way they're going to test that is they're going to test those assertions by looking at your credentials, looking at criteria, looking at references. There's also going to be other tests that they will perform. Like when you've been on the job for a while, they'll give you a review. They'll check and see, have you done your job effectively? They will evaluate your performance. All of these are kind of getting to that same idea that we're going to be able to make sure that you are doing what you say you're capable of doing. By the way, this concept is something you've probably heard before, but we already talked about the fact that you want a good grade in this course, and I want you to learn auditing. And so we have a way of aligning those goals, okay? Aligning those goals. It's this concept of goal congruence. Has anybody heard that term before? Goal congruence? So it's basically saying that we can find a mechanism for ensuring that we accomplish the same goal. You get your grade you deserve, and I evaluate you upon your performance. Okay, I help you learn auditing. In this case, my goal career mechanism is going to be the exams that I give you in this course. So that's important to note. Now, when you make an assertion, you are making an implicit statement to me that you're making an assertion about this course, you're making an implicit statement about your knowledge, about your abilities. When you make an assertion toward your employer, you are making an implicit assertion, implicit statement about your abilities to perform the job. This idea of assertion actually is represented in financial statement auditing too. When a management team prepares the financial statements, they are making fundamental assertions about the state of the accounts in those financial statements and the state of the disclosures in the financial statements. We have, as auditors, have ways of categorizing those assertions. They are called management assertions because these are the assertions that management is making. Now, we're not going to go into a lot of depth on these, but you can kind of take a look at the list right here. There are going to be 8 assertions that we're going to talk about in this course. And if you don't have the time to write all this down, it's not a big deal. We're not going to really get into detail about this until chapter 5. But basically, when you hear the term assertion used in this course, you're going to assume that I'm talking about this particular topic, management assertions, or I may call them audit assertions, or I may even just use the term assertions, full stop. Okay. And they mean one of these 8 items. So what do these assertions represent? The idea behind these assertions are that if I look at a particular account or disclosure, they've got certain characteristics that represent that account or that assertion that's being represented. So let's go ahead and use a very simple one. So I'm going to, as an auditor, I'm interested in going to a company and looking at inventory, making sure the inventory is correct. And management's going to put on the financial statements on the balance sheet that the inventory balance is $1 million. Now, I, as an auditor, can actually say, what does management mean by putting $1 million on the financial statements? They're saying the inventory that they have exists. You can kind of see that's one of the assertions up here, existence occurrence, and that it's properly valued, valuation, allocation, and accuracy. I, as an auditor, I'm going to be concerned about testing to make sure that that inventory does exist and that it is properly valued. That is what my focus is going to be. So this is just a way of categorizing the representations that management makes in a way that makes sense to us as auditors. Now, again, it's not too concerning about what these represent. All you need to know is that these assertions are in place right now. Certain assertions are going to be relevant under certain sets of standards. You will notice that I've got some assertions over here that have got the words PCAOB and ones that have the words ASB next to it. We're going to talk about the PCAOB here in just a little bit, but the ASB stands for Auditing Standards Board. And that is a group, subset of the AICPA, the American Institute of Certified Public Accountants, that's responsible for standard setting for private companies or non-issuer companies. I'll talk about the PCAOB more here in just a second because that will come up later. By the way, if you're curious what MGP is, that's Messier, Glover, and Pratt, which are the authors of our textbook. Why do I put their initials up there? Because authorization is not really a management assertion, but no matter how many times I tell the publishers to get rid of it, they keep putting it in the friggin' book, okay? It's still in the book. It's 2025. It hasn't been assertion since the entire time I've been teaching, and it's still up there as an assertion. It is not a real assertion, but I can include it up there so it doesn't get confusing for you all when you do your reading. So what do we know about authorization? Not a real assertion, but it's still going to be included on our slides. All right. So the way that we conduct an audit is going to align very closely with the way that management prepares financial information, what you learned back in your financial accounting courses. So management implements controls, they conduct transactions, they accumulate the transactions, they prepare the financial statements, and we're going to issue the financial statements to the users. The way that we as auditors look at this is we're going to gain evidence about the controls and about the transactions, and we're going to make a determination of what these represent. So one thing that's going to be important to note is we're going to be testing both controls and transactions. Those of you who took AIS, remember how excited I used to get about controls? Yeah, that's one of the reasons, because I'm an auditor. I like testing controls, but we'll get to that here in just a little bit. Then we're going to look at the what management has prepared, and we're going to test those against the criteria, which our criteria is going to be GAAP, generally accepted accounting principles. We're going to test whether the assertions are truly represented as management has said. We're going to evaluate the overall financial statements, and we're going to issue an opinion in the form of a report that says whether these financial statements are good or whether they're not good, which we'll get into that in just a second. But let's talk about some fundamental concepts that are important to an audit. There are 3 of them: materiality, audit risk, and audit evidence. Now, we're going to talk about these more in detail individually here in just a second, but it's important to note the first two, materiality and audit risk, these affect the nature, extent, and timing of audit evidence to be gathered. So these two will affect this third one right here. And basically what that means is if we say something is, if we establish different levels of materiality and audit risk, it may change how much evidence we have to gather. Okay. And once we understand the nature of materiality, we'll talk about that in chapter 3, which we're going to start talking about next week, and we'll finish, or sorry, at the end of this week, and we'll finish next week. And then chapter 4, we talk about audit risk. It will become a lot more apparent about what we mean by evidence collection relative to these concepts here. But let's drill down a little bit more about, actually, first of all, let me kind of provide a little bit of a basic example, okay? A really simple example to kind of illustrate this point. So I tell you that evidence is based on how extreme the situation is, how extreme the statement is. So I make the statement, I am an accountant. How difficult do you think that would be to prove? I'm going to assign every single one of you in this room the task of proving Dr. Barnes is an accountant. Do you think you would have a hard time proving that?
No.
No, you just go to the website and you say, well, he's Michael V. Barnes. He's got a doctorate in accounting. He's got CPA after his name. Strong evidence that he's an accountant. He teaches accounting, for crying out loud. All right. So that's not a very extreme statement given the facts and circumstances. Pretty easy. Not much evidence needs to be gathered. All right. Second statement scenario. I am a superhero. All right. How much evidence would you need to gather to support that statement or refute that statement? Actually, refuting wouldn't be that hard. I'm definitely not a superhero. But if you need to support that statement, it would be really, really challenging because it's a pretty extreme statement. Okay. So that's kind of an example, is the nature of the statement, the nature of the assertion that we're trying to prove is going to affect how much evidence we have to gather. Well, let's talk about materiality. So, by the way, this is a picture of the Caden brothers, which this is, in case you don't know, this is Dr. Caden's oldest son, Jackson, over here. He just started at Truman State, so this is an older picture. He's a freshman this year at Truman State, and I can't wait for the day that he comes into my class and sits down over there and I show him a picture of himself from like 10 years previous. But I did get permission to use this, so I'm not just coming up pictures on Facebook. But your favorite band, the Caden Brothers, not to be confused with the Jonas Brothers, playing 2 dates in Kirksville. You've made the decision to skip auditing class to attend one of their performances. You have 2 possible choices. Missing a day, we're going to be working on an in-class assignment, which is 5 points, and missing a day that we'll take an exam, 100 points. All right, what's your choice? You're going to miss one of those 2 days because you can't miss this band's tour. I don't know why their concert is at 1:30 on a weekday, but yeah, you can't miss this particular band's tour. So what are you going to choose? A, why? Less points. Yeah. We don't have not any point in losing out. Okay. Now, this is assuming, of course, that you're using on the template of what we had right now. So this course, there's about 500 points, which losing 1% of your grade is probably not a big deal. Losing 20% of your grade, pretty big deal. Okay. So what if I change the circumstances a little bit and say there's 1,000,000 points possible in this class? Does that change your answer to this particular problem? Yeah, you're going to attend both concerts. So like both of them are just mostly material. 2 days out of auditing to see my favorite band? Why the heck not? Okay. Why the heck not? So it's important to note that when we think about materiality, we're thinking about not just the base amount, but also what the relative amount is. If I say that a company has $1,000,000 misstatement, is that material? For those of you who took AIS with me, you already know what the answer to the question is. Answer to every single accounting question. It depends. That's the answer to every single accounting question. Yes. Those of you who have not taken AIS with me, you get used to that because I'll say it a lot. All right. So it depends. All right. It depends on what the size of the company is. If it's Greek Corner Euros down the street, they would be out of business if they had $1,000,000 misstatement. If it's Walmart, they'd be like, yeah, it happens every day. Okay. So it really depends on the context. Materiality by definition, by the definition of the Financial Accounting Standards Board, is information is material if omitting it or misstating it could influence decisions that users make on the basis of the financial information of a specific reporting entity. So if the amount is enough to influence decision-making, it is considered material. Now, why is this word so important? It's because when we make our opinion, we are going to say whether the financial statements are free from material misstatement. We're going to evaluate whether the financial statements represent fairly in all material respects the financial position of the company. So that word materiality, really, really important, because if it's not enough to influence decision makers, we don't care. Like Some of you may say, if I lose $1 from my wallet, I'm not going to cry over it. I'm going to move on to my life just as it was. Some of you may say, I'm a college student. $1 is a tragedy. Okay. You have different thresholds of materiality, but we'll get more into that as we get to chapter 3. Let's talk about audit risk. The auditor's standard report states the audit provides reasonable assurance that the financial statements do not contain material misstatements. I want to stop real quick. That is the statement that's made in the auditor's report. And reasonable assurance is one that's used all the time. And we're going to hear that term used a lot in this course. But why don't we use absolute assurance?
Almost possible.
Yeah, it's not feasible. Yeah, it's not feasible. If you had to obtain absolute assurance that you were going to get a perfect score on the exam, how much studying would you have to do? Literally infinite, because I could ask you any number of questions. Okay. So yeah, it's not possible to maintain absolute assurance, which is why reasonable assurance is what we put in place. We are going to be reasonably certain we're going to do well in the exam. We're going to be reasonably certain the financial statements are free from material misstatement. So the reasonable assurance phrase implies that even when the auditor does a good job, there is some risk that a material misstatement could be present in the financial statements, the auditor will fail to detect it because we can't be perfect. We're just not capable of that as human beings. We have not designed audits where we can stop time and spend all of eternity auditing a particular account. So something may happen even if we do a good job. So audit risk is this idea the auditor may mistakenly express a clean opinion when the financial statements are materially misstated. In other words, the auditor says the financial statements are free from material misstatement when a misstatement actually exists. So that actually relates to some scientific concepts you may have actually talked about in other courses. Has anybody heard of type 1 or type 2 error? Yeah, we're going to actually see the words type 1 and type 2 a lot in this course because there's a lot of different classifications for that. But in scientific terminology, a type 1 error is saying that there is a problem when in fact no problem exists. Generally, as auditors, we don't care about that, okay? Because if there's a problem, fixing, or if there's no problem, fixing something that's said to be a problem will just result in basically being back to the starting point. But if we say that there is no problem when in fact a problem exists, that is a tragedy. That's basically the type 2 error is considered to be in scientific vernacular to be the bigger issue, a bigger concern, and it's definitely a bigger concern for us as auditors. So that audit risk is something that we're very concerned about. We're very concerned about when we say something is fine when in fact a problem occurs. All right, so we've talked about materiality, we've talked about audit risk, but remember, to be able to make any assessments on this, we have to gather evidence. And our evidence is going to be related to those assertions we were talking about before. What do we mean by evidence? Well, buckle up, because we're talking about all that right there. Buckle up right there. Okay. So these are the types of evidence we're going to be talking about in this course. This is actually not an exhaustive list. There's only 8 listed up here. We have 2 more that are listed, but they're subsets of inspection of records and documents. They're called vouching and tracing. You don't need to worry too much about that now. We're going to actually have a discussion activity where we go through all types of evidence. But basically what this means is that we are going to design ways to test these assertions through the use of financial and non-financial information, or accounting information and non-accounting information. So, for example, if I say I want you to test the cash balance of an account, could you collect a document to be able to determine if the cash balance is accurate? Probably like a bank statement, something like that. That would be an easy way to test that. So that would be an easy way to identify a piece of evidence, a record or document that could use to test that particular item. But are there other ways that we could actually test other than just getting accounting records? And the answer is yes. In fact, there's a whole bunch of other ways listed here. Say, for example, I want to determine if a building that a client has in the books that they say is worth $2 million actually exists. What would be an easy way to do that? Well, you say, well, I just look at the document. Could a document be forged? Yeah, they could create a document when there's no building. So what's one way I could determine if a building actually exists? I could go to the building. I can inspect a tangible asset. Okay, I can inspect a tangible asset. I've got a client who says that they've got a $20,000 receivable with one of their customers. Okay, I can look at the documentation and I can determine the documentation really says there's a $20,000 receivable. But as we said before, the documentation could be forged. It could be falsified. What's another way that I could determine if that customer actually owes the client $20,000? An inquiry or a third party. So technically speaking, your inquiry is correct because inquiry is the kind of idea we do. But when we talk about inquiry from an auditing perspective, we're generally talking about an internal request. When we talk about a third party request, we call that a confirmation. Okay, where we confirm information from a third party. But you were correct. It is an inquiry, a form of inquiry. So yeah, all of these are ways of gathering evidence to determine whether or not the assertions being made are correct. Again, don't worry about this list. When it comes to chapter 5, worry about the list, okay? And this is one of those things I talked about on Monday. Remember, I said knowing content versus memorizing content. It will not be sufficient to memorize this list. If you know the names of all these, you're about 10% of the way there. You're going to have to know what they all represent and how they're used, which sounds really, really ominous and tedious, but I promise you by the time we get to chapter 5, we'll have plenty of reinforcement for that. All right. So I said that when they issue a report, they're issuing an opinion. So what types of opinions can an auditor issue? There are 4 that we need to be aware of. The one that's the most common is called an unqualified report, an unqualified opinion, an unqualified opinion. And unqualified, it's a little bit misleading because you say if somebody's unqualified that they can't do the job. When we say unqualified in this context, we're saying there are no qualifications being assessed. We don't have to make any modifications to the report. It can be used as is. Or I shouldn't say that. We don't have to make any modifications to our opinion, not so much the report, any modifications to our opinion. So unqualified is good. Unqualified is good. It means that everything is fine. There are no problems. Please make a note of this. The term unqualified is what we used for publicly traded companies. When we talk about a non-publicly traded company, about a non-issuer company or a private company, we use the term unmodified. Now, why does the ASB do this? I don't know. They just want to be disagreeable, I guess. But the term unmodified and unqualified mean the same thing. There is no modifications necessary to the report. We can use it just as is. So if unqualified means everything is good, what do you think the natural next step is if there is a problem? Qualified, yes, qualified. Qualified just basically means that everything is fine except for 1 or 2 things. I want you to make a note of this. The reason I use this particular graphic is because it has 2 words that are characteristic of a qualified opinion, except for. All qualified opinions will have those 2 words in them. Basically, we're saying that there is a problem, but it's not a massive problem. It's just a problem that has to be dealt with. This can arise in one of 2 ways. The first way is that there is a material departure from generally accepted accounting principles, material departure from GAAP. The other way this can arise is that there's a material scope limitation. Now that terminology is really, really important to note because we're going to hear that a lot. Scope limitation, okay? So where have you heard the term scope? And I don't mean mouthwash, okay? What does a scope mean? What you can view, it's what's apparent to you, okay? So if you got your hands out here, you can pretty much see everything. What if you put your hands right here? Does that limit your scope? Yes. That's kind of the idea behind this, is that something is preventing you from seeing everything you need to see. Something is limiting your scope. So the word material is really important there because material means that it's significant enough to affect the decisions of users, but it's not massive. What happens when something is massive? Or as we auditors like to use the term pervasive. That is where we get to our really extreme opinions. That's where we get into something called an adverse opinion. Adverse is just basically saying everything is a mess. More technically speaking, this is where we have a pervasive, and pervasive in this context means larger than material, pervasive departure from GAAP. So your client asserts that they've got $1 billion in inventory. You go and test it and they've got $0 in inventory. There is a pervasive misstatement on their financial statements. They can no longer be relied upon. The other possibility has to do with a pervasive scope limitation. This is called a disclaimer of opinion. It's the opposite of issuing an opinion. It's saying, I will not issue an opinion because I could not do my job. So remember, scope limitation looked like this. So it's a material scope limitation is like this. Disclaimer opinions like this, okay? I think your scope's probably pretty limited if you're like this. Pervasive scope limitation. We do not have enough information to do our job. Therefore, we are not going to issue an opinion. I want you to make a quick note There is one other possibility where you could issue a disclaimer of opinion. It comes up very rarely, and it will never come up in publicly traded audits, which is the focus of this course. That is if the auditor is not independent from the client. What does that mean? It's not important right now, but it will be important in the future. So if the auditor is not independent from the client, they cannot issue an opinion. All right. So where we're going to go from here, we're going to move on to chapter 3, and we're going to talk about client acceptance and continuance, preliminary engagement activities, and then planning the audit. From there, from the planning the audit, we're going to talk a little bit about risk assessment in chapter 4. Then we're going to talk about assertions, evidence, and documentation in chapter 5. Then we're going to have an exam. Then we're going to move on to internal controls in chapter 6 and 7. And then we're going to skip, because this is a little bit old and antiquated, we're going to jump to 17 and 18. Then for the final part of the course, we're going to jump to the business process areas in chapters 10 and 16. The reason that I save those for last is because we need to know how to do all the testing before we apply it to specific situations. Once we get to that point, though, we will have that knowledge and we'll be able to say, how do I use this for the revenue process? How do I use this for the procurement process? Real quick note. When we talk about auditing, it's the subset of a couple of different areas that you may have heard the term before. In fact, if you had an internship before, you probably did an auditing. It was probably not an auditing internship. It was called an assurance internship or an attestation internship. Basically, auditing is a subset of attestation, which itself is a subset of assurance. The way that we define attestation is kind of similar to the way we define auditing. It's just more general. It occurs when a practitioner is engaged to issue a report on subject matter or an assertion about subject matter as the responsibility of another party. And assurance is far more general than that. It's just independent professional services that improve the quality of information or its context for decision makers. Basically, what you need to know right now, and you won't need to know more than this until we get to the end of the second exam preparation, is that auditing is part of attestation and part of assurance. And they kind of fall within one another, these concentric ovals right here. I don't know if the concentric ovals are a thing, but they kind of look concentric. All right, so let's wrap up chapter 1 with a couple of philosophical thoughts. So we talked about exams earlier. Is it possible to do well on an exam without knowing the material covered on the exam? I mean, yeah, but you do have to use a loophole. You could get really lucky and get all the multiple choice correct and then just submit that. Hopefully that's enough. You could also do something unsavory. What's that called? Cheating. Yeah, all right. Are there reasons why the most competent and qualified candidate for the job may not get hired? Could they falsify their resume? Oh, do you think that happens in the real world? Yeah, maybe a little bit, maybe once or twice. Okay. How about this? Do the ends justify the means? If I get the job, does it matter whether or not I falsified my resume? Probably does. The ends do not necessarily justify the means. And that's kind of the point that I'm trying to make. Okay. So I want to kind of use a really gruesome example. So those of you who took AIS with me, what's my favorite food? Cheeseburgers, yes, cheeseburgers. And I usually eat cheeseburgers twice a day at my favorite restaurant. Does anybody remember that? So it's a place called Seabreeze north of town. Okay. It's a farm to table market. They're a farm to table restaurant. They're only open Thursdays through Sundays. They're a little bit expensive, but I'm a cheeseburger freak, so I can't help it. Okay. Anyway, I'm going to give you a visual example, and I want to disclaim this by saying this has never happened to my knowledge at Seabreeze. They've always treated me very, very well, but I do think this is a really important one to say. So let's say Thursday, tomorrow, I'm going to go get my traditional cheeseburger, and I'm sitting down really excited for my cheeseburger. And I see them preparing my cheeseburger, and I'm just really excited. And I just know that it's going to be delicious because it always is, because that's why I love cheeseburgers. And then I see the guy preparing the cheeseburger, and he sneezes on my cheeseburger. All right, am I going to eat that cheeseburger? Give me some credit. No. Okay. Does it matter that cheeseburger is still delicious? At some point, we have to actually say, it doesn't matter if that thing's going to taste good. I'm not putting that in my body. Okay. Yeah. So that's kind of the example I'm saying, is that we have to care not just about the end result, but we have to care about the process. Can we all agree to that? All right. So why is this relevant? Well, prior to 2002, audits were really focused on the end result, the financial statements, and the process was kind of an afterthought. So that has to do with internal controls. It was optional and basically was not required. But then we had this thing called the Sarbanes-Oxley Act 2002, which instituted required auditor testing of internal controls. Make a note of this. This was for all publicly traded companies. or at least all paid publicly traded companies over a certain threshold. It used to be $75 million in annual revenues. Now I think it's $100 million in annual revenues. But for our purposes, it's going to be all publicly traded companies. The goal here is to note not just what the end results are, what the financial statements say, but how did the client and how did the auditors determine that those results are accurate? So that's why internal controls is going to be an important focus of this course, because we want to know the process by which the ends are achieved. Want to know that that cheeseburger is free of sneeze. It's not a sneeze burger. That's not my joke, by the way. That's a former student that called it a sneeze burger. So, all right. So that's chapter 1. We got 10 minutes to cover chapter 2, but the good news is this is a much lighter chapter. There's a lot less content that I want to cover. So there's different types of auditors that we're going to be talking about over the course of the semester. The one that we're going to focus very heavily on, 98% of our content will come about this auditor's work, are external auditors. These are people who work outside of the organization. They're independent from the company, and they come in and provide attest services for that client. We also have individuals called internal auditors. They are employees of the organization they work for, and they provide value services, not just for financial reporting and controls, but for other areas as well. We do have government auditors, which are just as they sound. They do governmental functions. They can be in a number of areas, not just restricted to attestation and assurance. And then we have forensic auditors. Okay, forensic auditors only come in when there's a fraud problem. Okay, when there's a fraud issue being like, whether that be fraud prevention or detection and correction. By the way, who has 2 thumbs and used to be a forensic auditor? This guy. That's such a corny joke. I know. Sorry, guys. I'm not getting rid of it, but it's a corny joke. It's a corny joke. So what are some other audit services? Well, we've got our internal control audits, which we're going to make a note of this because internal control audits are going to be required in this course. Because I said the focus of this course is going to be publicly traded companies, which is going to be the where internal control audits are required. We can also have compliance audits, which when you hear compliance, you should think laws and regulations. Do they meet the rules of the industry in which they're operating in? Operational audits, which would be the only type of audit that Dr. Otero would put her thumbs up to, because this is about operations that are local to an organization, the rules of which the individual organization applies, their procedures and policies for that company. And forensic audits, just as they sound, does an organization have the proper protocols in place and the proper procedures in place to prevent fraud or detect and correct it on a timely basis? Auditors can also engage in other types of attestation and assurance services, though some non-audit services and some non-audit services. But it's important to note that most non-audit services are now prohibited by the SEC. You may ask, why are non-audit services prohibited by the SEC? Hey, Dr. Barnes, I really want to know, and I'm about to explain it to you, okay? Because prior to 2022, 2002, the auditing profession was self-regulated, which means the auditors reviewed the work of other auditors. There was a bit of a problem with that because a lot of auditors had side gigs with the same client. Good example of this was Anderson had $25 million of audit fees and $27 million of non-audit fees. So they were very heavily incentivized to try to avoid, or this is, Anderson with Enron, if I forgot to mention Enron, my apologies. Anderson had $25 million of audit fees and $27 million in non-audit fees with Enron. So they were very heavily incentivized to try to make sure that Enron was happy. Does anybody know what happened in that particular situation? Did not go well for either organization, by the way. Did not go well. Google it. I can't do everything for you, okay? But what happened after that? Well, we had the Big E collapse, then we had WorldCom collapse, then we had the Tyco fraud, then we had Health South fraud, then we had Adelphia. So a whole bunch of different frauds occurred all simultaneously because everybody was doing the same thing. First of all, auditors were basically giving their clients a sweet deal because they wanted to keep them on for their non-audit services. And then the other auditors were saying, that looks good to me. What happens if we self-regulate in this class, by the way? If I say, hey, instead of me grading the exam, why don't you just pass it to your neighbor? I think the grade point average on the exams or the grades on the exams would go way up, okay? You scratch my back, I scratch yours. That's kind of the idea that's going on. All right, so what happened as a result? This, SOX, 3 important letters that affect accounting even today, back in 2002, the Sarbanes-Oxley Act of 2002. So you probably have learned a lot about SOX already, but one of the most important aspects of SOX that you need to be familiar with are 5 letters, the PCAOB, the Public Company Accounting Oversight Board. So remember I talked about the Auditing Standards Board a little while ago? Prior to 2002, all companies, public and private, were subject to the rules of the Auditing Standards Board and the AICPA. Now, all public companies have to follow the rules of the Public Company Accounting Oversight Board, and they are far more stringent than the AICPA rules. So these are for the really large companies that are traded on open exchanges. That's why we've seen a lot of frauds recently, and by the way, with companies that are private equity firms, so they can avoid exposure in this regard. Because one of the things that PCAOB mandates is that they have to have annual financial statement audits to be traded on the U.S. exchange. That's why that's a focus of this organization, or this organization. Why it's a focus of this course, by the way, because these will be something that come up every single year. All right, a few more slides, and we're going to wrap it up here. All right. So we're going to hear these concepts of due professional care and professional skepticism. These are related concepts. So an auditor has to exercise due professional care and audit, which basically means that they have to be professionally skeptical. They have to have an attitude that includes a questioning mind and a critical assessment of audit evidence. Now, this is a little bit difficult to convey in a classroom setting because I'm going to tell you a lot of information and you're going to say, well, that sounds correct. He's been teaching this class for 10 years now, so he probably knows what he's talking about. In the real world, you don't want to take anything ever at face value. When you go to a client, they're going to tell you something and you want to make sure that you corroborate the heck out of that information. The manager tells you, oh, yeah, that's just an accounting trick that we use. It's not a big deal. The clients, the owners are not going to care if we do that. All right. That's a point where you should raise that red flag and say, I call foul. I call foul. All right. That's what professional skepticism tells us. It's important to note that if we are not professionally skeptical, not only will we fail the audit, but we can be held liable for any failures that we don't demonstrate. So in addition to regulatory bodies, auditors are generally accountable to the governing body of the organization, which is called corporate governance. Now, you probably have heard the term corporate governance before. We're going to talk about it in the very next lecture on Friday, so I'm not going to get too much in depth on it. But corporate governance is kind of our end run. That's where we're going to be talking to the individuals who are kind of seeing the organizational high level, not management, but usually the board of directors and other groups as well. So corporate governance is kind of where we're ultimately accountable to within the organization. I do want to throw this out here. So board of directors and audit committee is a subset of the board of directors, but we'll talk more about those when we get to them here on Friday. I do want to talk really quickly about the business processes. These should look fairly familiar, or at least some of these should look fairly familiar. If you remember, back in AIS, we talked about revenue process. Then we talked about the procurement process. Does everybody remember procurement? So what's the difference between the procurement process and the purchasing process? It's a trick question. There is none. Okay. It's just two different words for the same thing. Okay. It's called purchasing processes in this textbook, and it's called procurement back in AIS, but they mean exactly the same thing. So revenue and purchasing process. We also talked about kind of inventory management there. We're going to introduce some other process areas in this course. We're going to talk about human resources, and then we're also going to talk about financing and investing, which are going to be multiple chapters because they're going to cover everything else on the financial statements that we have not covered on the other areas. But basically what we're going to find is these all represent certain line items within the financial statements that we're very concerned about as auditors, trying to make sure that they are fundamentally correct when we're going through our audit. Last thing I want to talk about is something that's a little bit hard to teach, but we're going to do a few different exercises and activities. So you probably heard the term ethics before. And can we say that accountants strive to be ethical? Yeah, I would say that we have one of these occupations is held to a high standard of ethical behavior. And when we fail, it's considered to be very, very newsworthy. Like they don't ever report on the news. They don't say, well, today 99.9% of all accountants were completely ethical and did their job correctly. They're going to report on that 0.1% that did a bad job, especially if it's something that's really, really big and massive. That's what you see in the news. We are a very ethical group of individuals, but we have a few people who do bad things for certain reasons, and those are the ones who kind of spoil our reputation. But we've got a very, very stringent code of ethics that we follow. And so this kind of reflected in something called the Code of Professional Conduct. So professionalism refers to the conduct, aims, and qualities that characterize a profession or professional practice. Very, very closely tied to the idea of ethics. The whole point is that you can be ethical without being professional, but it's very, very difficult to be professional without being ethical. So ethics is a requirement of professionalism, So the Code of Professional Conduct, basically it says these are some rules that we have to follow as auditors. It's principles, rules of conduct, and interpretation of the rules of conduct. We are actually going to talk a lot about this after the second exam. It's going to be our catch-up section. So just for context, in addition to the chapters that we've already talked about, we're going to have a discussion of the professional judgment framework immediately after the first exam. And then we're going to have the discussion of the code of professional conduct after the second exam. So these will be kind of standalone activities that are related to the content, but not directly related to auditor testing. Basically, what this is going to be is just how do we actually interpret what this represents for us? And the answer is it's generally pretty straightforward as long as we know the rules that are in certain areas. The reason I bring this up is something that's going to come up quite a bit over the course of the semester is this idea of auditors' independence. And independence basically means that we cannot have any material interest in our clients, direct or material indirect interest in our client if we're going to perform the audit. It's just not something that we can possibly do. Now, there are a lot of rules that underpin that, a lot of certain steps that we have to follow to make sure that we are truly independent. But for right now, you just need to know we need to be independent both in fact and appearance to be able to do our job properly. And that's it. Wow, I didn't think we were going to get through it all, but we did. So we'll be back here. Homework is due on Friday, but at the beginning of class, so please make sure you complete the chapter 1 and 2 homework. And I will see you all then. Yes, sir.